Market down. June 20th was the worst day of 2013 for the stock market as every asset class got hammered. What exactly happened? Welcome to a special edition of the SEM Traders blog. We're coming to you live from the SEM Traders desk. And we just wanted to go over briefly what happened today in the markets, as it was a down day. And there's a few things that we saw on our screens that we thought we should point out to all of our listeners and viewers out there. First of all, today was one of those deleveraging days where every asset class was down. You saw bonds, stocks, commodities all selling off. Now, the catalyst, of course, was yesterday's Federal Reserve press conference and policy statement, where they basically said that they're going to slow down the pace of quantitative easing, which is their stimulus program to try to help the economy, sometime later this year, with it possibly ending as early as the middle of next year. Now, a lot of people feel that the Federal Reserve is being overly confident, and they don't feel that the economy is able to stand on its own. And so we've kind of seen a disagreement where some people are out there saying, well, if the Federal Reserve says the economy is doing well, then that's a good thing for stocks. But the problem is that it's really not doing that well, and the Federal Reserve has a history of missing their forecasts, and I believe that's what happened with the market today. Now, if you look a little bit deeper, the sell-off accelerated as the day went on, and for the second day in a row, it closed at the lows of the day, and that's always a negative sign when you see the big institutions come in and do a lot of selling at the end of the day. I also got a little bit of a sense that there was some forced selling going on. Now, we saw this back in April when we saw that couple-day flash crash in the price of gold, where people that were long one asset class and started losing money on it, because they had bought it on leverage, they had to go ahead and sell other asset classes. So they sold everything. Like I said, bonds, stocks, commodities all took a hit. Now, one thing that I thought was interesting is that most of the equity selling in the U.S. was in the ETF market as well as the futures market. Now, we saw almost double the level of ETF selling that we normally see. So that kind of tells me that it may have been just a massive asset allocation. Maybe people were going short to hedge off their other exposure. But it is always interesting when you see ETFs and other indices lead the selling. Granted, the average stock was down. I think there was only about 100 stocks up on the New York Stock Exchange, but the heavy selling and the heavy volume did come in the ETF market. So that may be maybe a good thing for the bulls. Maybe it was showing some panic from the large institutions. One thing that I think will probably be missed in all the headlines is we saw the acceleration of the losses come following the report that the IMF is pulling aid from Greece. Now, here we are in summer again, and I hate to be talking about it, but we may be, what is it, part 3, part 4 now of this Greece crisis, where they're just not meeting their obligations, and on a day where it's become obvious that the credit markets are having problems still, almost 5 years after the crisis started, that everybody's on edge, and that led to a lot of selling. Again, emerging markets bonds were the worst. Fixed income component, high yield bonds really got hit, especially the ETFs. We also saw something interesting, that the CDS, the credit default swaps, which is basically an insurance contract on the high yield index, hit its highest level of the year. And so even though the index is only off about 4% from its high, and it's still up pretty nicely year to date, we've seen people get panicked and start to charge higher premiums because they feel that if the Federal Reserve is raising interest rates, we could be in for some problems down the road. We also have a few things working against the market. We have quarterly rebalancing, where maybe people are feeling like they're a little bit long stocks. They want to lock in the gains that they've had. Still have a double-digit first half of the year, which is nice. And so as we get close to the end of the quarter here in about 10 days, they want to sell their stocks and not necessarily buy bonds anymore. So that money seems to be going to the sidelines right now. This week is also options expiration. They call it quadruple witching. We have a whole bunch of futures and options contracts expiring tomorrow. That always adds to a little bit of volatility. But I think the big story of the day is what happened with the bond market. We saw the 10-year Treasury bond reach a level of 2.42%, which is the highest it's been since August of 2011. Now, 2.4 had kind of been a ceiling throughout 2011 and 2012. The last time we saw 2.42 was when it was actually coming down, and then we saw a few times where rates spiked back up, but they always peaked out at 2.4. Now, we've heard a lot of bulls say, come across TV, there may be somebody on over my head right there on CNBC now talking about, hey, higher rates means because of the economy getting better, it's okay. But what we just don't know, and this is why everybody panicked today, is we don't know if the bond market and thus the stock market can stand on its own. Until we do, a lot of people are taking to the sidelines and deciding, maybe we should wait. Strategic Equity about 3 or 4 weeks ago actually decided we should get to the sidelines, and we trimmed about half of our exposure to stocks and nearly all of our exposure to high yield bonds. And we take the tack that we'd rather wait for the market to rebound, and that's kind of in the position we're in right now. If you're not in that sort of a portfolio, or you would like to learn more of how you could take advantage of Strategic Equity's active management, I'd encourage you to go to our website. It's semtradersblog.com. I'd also, if you're an advisor out there and you want to learn more, contact our office. It's 1-800-408-2423. Hopefully we won't be doing too many more of these special updates, but if the market continues to be volatile, we want to get the most timely information out there, and that's what we're here for, everybody out there. That's why we're here. Until next time, my name's Jeff Hybiak, Portfolio Manager, Strategic Equity. Have a great day.